Hi and welcome to this finance lecture for Stockholm Business School. I will talk about options today, or I will introduce options. I think we should start with an introductory example of what not actually is an option, but it can be viewed as an option. For example, you might have had some discount coupons on a grocery store. In this case, I have a discount coupon on fillet of beef from the grocery store. I can, with the coupon, purchase 1 kilo of fillet of beef for $30. This contract can be viewed as a call option. I will come back to that later. But if we look closer to this example, or to this grocery store example, if the store price, or if the price in the store is above $30, I would find this coupon valuable, since I can buy something that is more expensive for something less. In this case, I can buy the fillet of beef for $30 when it's cost more. And if the price instead is below $30, let's say that the price of fillet of beef is $25. If we assume I would like to purchase some fillet of beef, I would be stupid if I used the coupon. If the price is $25, I wouldn't pay $30 with the help of the coupon, right? So if the price is below $30, the coupon is useless. It's not worth something for me. So we can conclude that it is the holder that can use the coupon. So the grocery store cannot force me to use the coupon. If the price is below $30, I will not use the coupon. But if it's above $30, I would use the coupon to buy the fillet of beef cheaper. So it's up to me to use the coupon and not up to the grocery store. So a coupon, or an option, when we come to option, does never have a negative value. Because if it would have a negative value, like if the fillet of beef costs $25 in the store and I use the coupon and pay $30, well, that just would not happen. We just wouldn't use the coupon to pay $30 for something that is worth $25. So if it would be a negative value, if we use the coupon, we just wouldn't use the coupon, and then it's useless or worthless. So it will never have a negative value. An option will never have a negative value for the holder. However, for the grocery store, the situation is of course reversed. If the value is positive for the holder will use the coupon and purchase the fillet of beef for a cheaper price, which of course is a negative value for the store's point of view. This grocery store can thus never choose whether the holder should use the coupon or not. Or well, they can set the price so that the coupon will not be used, but if the holder has the coupon, the holder can choose to use the coupon or not. It's not up to the store. So if we take this example and look what the value of the coupon is, if the price in the store is $40 respectively and $20 respectively. So the value of this discount coupon on fillet of beef for $30. So we have the right to purchase the fillet of beef for $30. So if the store price is $40, and we now assume that I would like to buy the meat, I as a holder would of course use the coupon, and for me the coupon is hence worth $10. So if we continue, if the store price is $20, well, if I would like to purchase the fillet of beef, I can choose now to purchase it for $20 or for $30? Well, I would obviously not purchase it for $30. I would buy it for the regular store price of $20. In other words, I would not use the coupon. If I have the right to purchase it for $30 but can purchase it for $20, I will of course choose the cheaper alternative. So the coupon is worthless. However, if we look at the store points of view, how is it in this case? Well, if I would buy the fillet of beef for $40, but now has the right to purchase it for $30 and use the coupon to buy it for $30 instead of $40, the store obviously loses $10. So if the price is $20, now we can think that, well, it's worth $10. But that is not correct, because I as a holder will not use the coupon. If the store price is $20 and I want the fillet of beef, I will buy it for $20. I will not use the coupon. Hence, the coupon is worthless even for the store. So we can see here that the holder's gain is the store's loss, so to speak. If I have a positive value of using the option, or in this case the discount coupon, I will use the discount coupon, and the store will lose money compared to if it would have sold the fillet of beef to me for the store price of $40. And some terminology. We say that an option is a derivative security, and now it's not connected to the slope. It's called a derivative security because the price or the value of the option is derived from one or more other securities, which is called underlying assets. If this was a real option, or if we view this example as an option, the underlying asset would be a fillet of beef. And we also say that an option is an agreement between two parties. The seller of an option is called the option writer. To write an option is also called to go short an option. And the buyer of an option is called the holder. And to hold an option is also called go long an option. And the holder purchases the option from the writer and pays a premium for the option. So it's of course worth something for me to have the opportunity to buy, for example, a stock at a certain price. If the current stock price is above this price, the option is valuable. And to get this opportunity, I would of course have to pay something, and this is the premium. And the premium is also called the market price. So we have different kinds of options. We have a call option, which is what we had in the previous example. And it gives the holder the right to purchase an underlying asset at a certain price by a certain date. So in our example, I had the opportunity to purchase a fillet of beef for $30, a certain price, perhaps before Wednesday, by a certain date. There's also put options. The put option gives the holder the right to sell an underlying asset at a certain price by a certain date. So it's the same, but you are allowed to sell an asset instead of purchasing an asset. Well, it might not be applicable to our example because I might not get a coupon to sell fillet of beef for ICA or another grocery store. But, well, you can see that it could be a stock, for example, and then I have the right to sell the stock at a certain price by a certain date. and we have a so-called strike price. The strike price is the certain price, as we said. The strike price is the price at which the holder can purchase or sell the underlying asset. So if I have the right to buy the fillet of beef for $30, then the strike price is $30. And we have an expiration date, or option maturity, or maturity date. You can call it a bunch of stuff. But it's the last day the option can be exercised. We also split options into European options, where a European option only can be exercised on the expiration day. So in the fillet of beef example, perhaps it could say that you have the right to purchase fillet of beef on Saturday for $30. Then it will be a European option. We also have American options, and American options can be exercised on or before the specified expiration date. So again, in our example, it could be that you have the right to purchase the fillet of beef for $30 this week, so before Sunday, some date. We have said this, but the option holder has the right, but not the obligation to use, hence exercise, the option. And of course only does so if the option is profitable, or if the exercise is profitable. If I gain something in using the coupon or using the option, I will use it. If I don't gain anything, I will not use it. So, for example, if I have a call option on Apple with a strike price of $110, I have the right, but not the obligation, to purchase the Apple stock for $110. Today, November 7th, 2014, the Apple stock costs $109. I can, with the option, purchase the stock for $110. Would I buy the stock for $110 if it's worth $109? Well, perhaps it sounds quite stupid, but we can at least imagine that we would. So I pay $110 with the help of the option for something that is worth $109. So if I immediately sell the stock on the market, I would lose $1 because I pay $110 and I get $109. Obviously, this is not a good. You wouldn't use the option, of course. But imagine that the stock today was worth $111. So the current stock price is $111. If I would use the option, I would pay $110 for something that is worth $111. I have no idea what happened here. If I would sell a stock, I would sell it on the market for $111 for something that I paid $110 for. Hence, I gain $1. Yeah, I would use the option, of course, since I earn money on it. So, from the seller, or as we call it, the writer's point of view, they have to fulfill the contract. So if I want to use the option, they have to fulfill the contract. They can only hope for the stock price not to rise as much. I mean, imagine if the Apple stock rises to $200. I would earn $90, and hence the writer would lose $90. So we see that the writer always loses on the option, basically. But what happens when I buy an option? Simplified, this is what's happened when I buy an option. The writer writes a contract that gives the counterparty, the holder, the right to purchase, in this case the Apple stock, for $110. The bank then agrees to sell this contract, or this option, for some price, the premium. Let's say $2. If I want to buy this option, I will thus need to pay $2. The seller then has the obligation to sell the Apple stock for me to $110 if I would like to use the option. So I pay $2 for the right to purchase Apple stock for $110 sometime in the future. I don't have to buy it, but I can. So the writer collects the premium and hopes that the stock does not rise. In practice, however, the writer will try to protect itself against losses by, for example, purchasing Apple stock itself. However, this is not that much covered in the course, so I don't talk about that. So now we talk about the value on the expiration day. The following factors determine if we make a profit or a loss. First of all, the difference between the strike price and the spot price. So as we said, if the fillet of beef is expensive in the store and I have the right to purchase it cheaper with use of the coupon, it's worth something. I make a profit on the coupon. If the option is a put or a call option. So if I have the right to purchase the Apple stock for $110, I would like the stock to be very expensive at the moment. I would like it to cost as much as possible. But if I have the put option and I can sell the stock for $110, I obviously want the stock to be cheap. I want to sell something cheap, more expensive. And also, if we are the writer or the holder of the option. The holder has the right but not the obligation to use the option. So if we are the holder, we will always have a positive value on the option, or at worst 0. The writer, on the other hand, will never have a positive value on the option because the holder in this case will not use the option. And last, the premium that we paid for the option. So we paid something to get the opportunity to use the option. This is the premium, and the premium also defines the profit we make. So the call option value on the expiration day for the holder is the maximum value of the spot price minus the strike price, or 0, depending on which is the greatest. So, as in the fillet of beef example, if the spot price of fillet of beef is higher than the strike price, the $30 that the coupon gave me the right to purchase it for, this is my profit, or the value on the option. But on the other hand, if the price is below the strike price, so if the fillet of beef is very cheap in the store, I will not use the option or the coupon, why it's worth nothing. And this can be written as like this, where you take the maximum value of the spot price minus the strike price. K is the strike price and S is the spot price, or 0. So the maximum of the difference between these two, or 0. The put option value on the expiration day, however, is the maximum value of the strike price minus the spot price, or 0. So if the strike price is above the spot price, we gain. So as we said, that if we have the right to sell something more expensive than it is we would like to sell it more expensive, and we would use the option. So if we have the right to sell the Apple stock for $110, when the price is $100, we would gain $10, the difference here. If the spot price instead is $120, we would not sell it for $110, where we would not use the option and the value is 0. And as before, S is the spot price and K is the strike price. So K here, this is the price to which I'm allowed to sell the underlying asset for. And this is the current price on the market for that asset. So in the Apple stock example, it is the current stock price. As we mentioned before, for the writer, on the other hand, the value is the reversed, since the writer has to fulfill the contract. The writer has the obligation, but not the right. So if we summarize for the holder and the writer, the different values. For example, the value for the holder for a call option is the maximum of the spot price minus the strike price, or 0. And the value for the writer on a call option is minus the maximum value of spot price minus strike price, or 0. So it's basically just a minus before the holder's value. So if the holder's value is 10, the writer's value is minus 10. And in the put option case, the value for the holder is the maximum of strike price minus the spot price, or 0. And for the writer, then it's just minus the maximum value of strike price minus the spot price, or 0. So if the strike price is above the spot price, the holder will use the option to sell this underlying asset too expensive, while I as a writer will lose money. I will have to buy the asset too expensive. So the holder has the right to sell the asset to the writer, and if the holder has the right to sell the asset more expensive than on the market, the holder needs to buy it more expensive than on the market. Hence the holder lose money. So we can conclude that for the holder, the value on the expiration day is at worst 0. And for the writer, the value is at best 0. So if the holder has a positive value of using the option, the holder will use the option and the writer will lose money. And that was all for today. We will get back to option next time. Thank you very much.